Well, it's a very good morning from me, and it's a very good morning from him. I hope everybody is well. Welcome to my Monday lunchtime live stream. Rebranded it Monday lunchtime. Sounds better. I'm Paul Archer, but again, I think you know that, so there's no need for me to say hi. I hope you're all well, but I hope you are well. Hope you had a good weekend, and all is fine in your world. Obviously, we had our clocks going backwards at the weekend here in the UK, because when in the autumn, the Americans call it the fall, don't they? So the clocks fall backwards by an hour. Now, a lot of people have been talking to me over the last couple of days, people in the mortgage sector, people in their 20s, and they're asking when interest rates are going to come down. They think it's a temporary thing. It's not. I think we need to get good with that in our heads, because you may well be used to very low interest rates thinking that's the norm. It's not. Interest rates are going up. The Bank of England are meeting later this week, aren't they? They're going to whack it up by at least 1%. Fixed rates had a bit of a and then back down again when we had the gilt issues back in that mini budget fiasco, because the gilt yields just rocketed because of the LDIs from the insurance companies. It was an issue, and we talked about that the other week. So the 2-year, 3-year fixed rates were stupidly, ridiculously high. They're coming down a little bit, but the upward trend is upwards. Don't forget about that. So let's talk about the impact of that today, because as a mortgage advisor, you need to be thinking about what you're going to be doing next year and how things are going to be changing. You need to adapt now to this, because you may not be used to high interest rates. You're going to have to get used to your client base accepting higher interest rates and what that means to your business as well. And we're going to be talking about that as the autumn progresses. We've got exciting plans for you next year as well. Anyway, enough of that. Let's talk about some of the topics that we've got planned for you. Hope all is good. Hope you're enjoying the brighter mornings. I was up this morning at an 8 o'clock meeting this morning with some clients over in India, and it was bright when I woke up this morning, which was quite lovely, wasn't it? I don't know how long that will last for. Anyway, talk about brightness. Let's get into annuities, shall we? Let's talk about annuities. Let's head over to the whiteboard for this one. Because what I want to do now is give you a bit of a technical update this morning on annuities. Now, why am I doing this? Well, they've become vogue again. So let's just put a little title up here for you. And what I want to talk about is annuities and how they affect mortgage advisors. That's really where I want to go with this one. So the title here is annuities. Now, you probably remember those from your CMAT training, but annuities and mortgage advice. There you go. One of the challenges with CMAT 1 and some of your CPD as well is that you read about annuities. You think, well, they don't affect me. I'm not a wealth planner or pensions advisor, so I'm not going to get involved with you. But they do affect mortgage advice, and I want to share with you how these CMAT 1E type topics do affect the advice that you give as a mortgage advisor. So, what is an annuity, and why are they all the vogue at the moment? Well, an annuity is a return on money which is based around gilt yields. Now, gilts, of course, as we know, fixed interests have been going on upwards recently since the mini budget. In fact, before then as well. Gilt yields, as they call them, are on their way up, and that's good news if you're an annuity holder or you want to purchase an annuity, because they're getting much more popular now. Now, Hargreaves Lansdown have quoted that the annuity rate is the highest since 2009. So, that's a long time now since annuities have been higher. So, it's good news. So, what is an annuity? Well, an annuity is you having a lump sum of money. You've got a big chunk of money, and you give that money to the insurance company. And the insurance company looks you up and down and says, right, okay, we'll have that big lump sum, thank you. And we're going to pay you £2,000 every year until you die. That's pretty much what the annuity is. So the insurance company, of course, takes this lump sum and they'll put it on in their investments. They'll put it in their gilt funds, and they'll pay you an income based around gilt returns. That's really where it comes from. So, of course, annuity income is much higher now because gilts are higher, and that's the key thing. So how then do annuities work? Let's talk about some of the detail with annuities. Now, there's two types of annuity for you. So let's get a little graph going over here. The first type of annuity is known as pension annuities. There you go. The pension annuity. Let's squeeze that in for you. Used to be called compulsory annuities because you had to buy them with a pension fund. Now, these are annuities that you purchase when you have a fund from a pension pot. So I've got a small pension pot which I've accumulated over the years from various pensions. I've got this pot of money. I can't just go and spend it, but you can withdraw it all now, but it's taxable under UF plus and FADs and things. But the point is, though, that this fund can be used to buy a pension annuity. The other type of annuity, which affects mortgage advisors a little bit more, are purchased annuities. So let's squeeze this one over here. Now, a purchased annuity, squeeze that in there. A purchased annuity is very different because this is something which you use to buy your annuity with your own money. You've got your own cash, your own fund from somewhere. You've saved money or whatever. So purchased annuity. So let's take a look at the different types. So I'm going to draw a little graph now for you, and we're going to get colour. Let's take a look at pension annuities first of all. So I've got here a little graph. So let's put the graph here so we can see how this is going to work. There you go. Now I've got two parts to my graph. The vertical, as you can see there, is the amount of money you're going to get. So high or low. And this one is the amount of time. So that's the graph there that I've got. For those of you on podcasts, you can't see this, but let's describe it to you as we go along. Now I've got 4 types of annuity under the pension annuity banner for you. The first type of annuity is a very straightforward one. It's called the level annuity. And what happens with the level annuity is that it pays you an amount of money which remains level until you die. So let's put a little coffin there for you, a little tombstone to indicate. And that's the whole point about annuities. It pays you an amount of money, this is known as level, until you die. So the amount of money it pays you is fixed. It doesn't go up, doesn't go down. It's paid every year until you die. And if you're looking at providing an income on retirement, that's a pretty good thing to have, isn't it? But of course, inflation now is hitting us all. CPI is nudging the 10% mark. We're back to high inflation as an economic ill. So people's income will be eroded by inflation. So what most people tend to do is they have what's called an indexed annuity, or an increasing annuity, call it what you like. Index means it's linked to some kind of index. What happens here is you get less to start with, but every year it typically increases with some kind of index, maybe CPI. It might increase by 5% or whatever it is. And that's known as an indexed annuity, which is easy to understand, isn't it? Really, if you think about it, it makes sense. You're going to start off with less, but as time goes on, it'll get bigger and bigger because inflation will keep it rising. But it handles the cost of living problem, doesn't it? There's another one called joint life. Let's squeeze this one in for you. Now, joint life annuity pays an income to a couple effectively. So let's squeeze that in there in green. Now, the whole point behind the joint life one there is that when you die, there's an indication of dying, the annuity, or a reduced amount normally, will then be payable to your spouse until they die. There you go. That's known as a joint annuity, which is what you want if there's a couple, if there's 2 of you. The last one is known as an enhanced annuity. Now, an enhanced annuity is payable to somebody whose life expectancy isn't as good as the average. Now, insurance companies, of course, are very good at assessing people's lifespans. That's why they're good at giving you annuities. They've got loads of data for that. But if you've got some kind of illness, some kind of condition, which means that you're not going to live as long as everybody else, you'll get what's called an enhanced annuity. Now, an enhanced annuity starts off at a much higher amount, as you can appreciate, because they're not going to have to pay it to you for very long, because you are going to die earlier than everybody else. That's the whole point behind it. Hence, the enhanced pays a little bit more. So they're the 4 different types of pension annuity. Come on to purchase annuities in a second. Now, the whole point behind the pension, this is the mortgage link for you, is that somebody has a fund. They have a pot. So let's draw the pot up for you. Now, people have a pensions pot. There you go. That's the end of the pot, isn't it? Now, that's money which they've built up. Now, that pensions pot can be taken in its entirety, but is taxable. You can though take a quarter of that pot as tax-free cash. Pension commencement lump sum, they call it. That 25% is tax-free. Now that is what mortgage advisors use to pay interest-only mortgages. Not so much these days because it's never really been popular, and most mortgage advisors can't give advice on pensions, so they tend to steer clear of it. But you could do an interest-only mortgage supported by the 25% tax-free cash of your pension. That's obviously a good thing. The rest of the fund or the pot is then used to buy the annuities we've just spoken about. So that's the old-fashioned way of doing it. That'll become more vogue now as people see annuity rates going up because, as I say, they have increased dramatically with the gilt changes. And that's important to know that. Let's take a look at purchased annuities next then. And we'll have the same graph because it'll be the right thing to do. So let's put the graph in here so you can see this working. There you go. Vertical is the amount of money and the horizontal is the time. Now remember, a purchased annuity is an annuity which you buy with your own money. And that's a very different one as well. The beautiful thing about this one is that some of the income is tax-free, which is if you had, say, £100,000 of your own money, which you gave to the insurance company to provide you with an annuity for the rest of your life, then they will pay you that income until you die. Now, you've given them £100,000. Now, some of that £100,000 is going to be given back to you each month or each year, whatever is the period in which you're receiving the income. And that return of capital is actually tax-free. The interest bit is taxable. So of your income from the annuity, a fair chunk of that is going to be just your money coming back to you each month. The rest of it is interest, which is based upon the gilt yield. Now, the interest is taxable. The capital return is tax-free. The pension annuity, by the way, is all taxable. And that's something to bear in mind. You get 4 types, which you might not have come across actually, so I want to describe these to you. The first one is known as a temporary annuity. Let's put that in green. Now, the temporary annuity is paid to you for a temporary period of time. There you go, temporary. And it might only be for, say, 10 years, and it stops. You don't die, it just stops. These used to be used for school fee planning. You bought an annuity for 10 years, and it paid money every month to pay for the school fees, or it paid every term. So you obviously get a bit more money that way as well. That's known as a temporary annuity. Again, mortgage advisors wouldn't come into touch with those sort of things very much at all. You have what's called a capital protected annuity. Now, capital protected annuity would pay annuity amount. Let's put capital protected there for you. Capital protected. It's payable until you die, obviously. But if you die early, what happens is it pays. Say, for example, you died at this point. Let's put a little tombstone in there to indicate your death. If you die early, it actually will return back the capital that's not been paid to you. You see where I'm coming from? So if you died, say, in the first 4 or 5 years, that means that you have the capital that the insurance company still got gets returned back to your fund. So in other words, your capital is protected that you originally gave them. It's good if you want to, if you think you'll die early, which nobody really knows, do they? That's known as capital protected. You can have a guaranteed annuity as well, similar. This means that the income is payable for a guaranteed length of time, whether you die or not. So it might be guaranteed for 5 or 10 years. So even if you died early, the income will still be paid for that 10-year term, and it will be paid to your estate. So that's known as a guaranteed annuity. Capital protected is another one as well. 2 types that affect mortgage advisors that are interesting. I'll put this one here. We've got one here called the long-term care annuity. I'm going to put it up here for you in red. The long-term care annuity. There you go. Sometimes called an immediate care annuity, long-term care. Now, the whole point behind this one is it's payable to the care home in which you are going into. Let's just draw a picture of a great big care home. Lots of windows and doors there. So what happens? This income that you buy with your annuity, with your lump sum, it goes straight to the care home. Now, because it goes straight to the care home, it has particularly good tax advantages. No tax to pay on it, you see. Whereas normal annuities, there's an element of income tax to pay. There's no tax because it goes straight to the care home. These are jolly good when you're saving in some kind of savings plan towards your long-term care, or you have a lump sum which you buy an immediate care annuity with that money, and it goes to care home. So if you're in that marketplace, later life lending, later life marketplace, long-term care, that affects you quite a lot. The other one is the home income plan. Let's put that in there for you. Now, if you remember the home income plan is a mortgage product or a later life mortgage product, home income plan, yeah. And what happens with the home income plan is that the legacy mortgage products that back in the 80s, 90s, you would borrow money and have to pay interest. But the interest is payable by you using that money to buy an annuity. And that annuity pays you an income, which you pay the interest on the mortgage, and it leaves you a little bit left over. That was the original intention of the legacy mortgage called the home income plan. And it's in the equity release syllabus if you're interested. Not around anymore, but that's what used to happen with that particular annuity. So there's a few more annuities for you under the purchase banner, which is quite interesting as well, isn't it? And that's annuities, really. Quite a lot to think about, a bit of technicals going in there. As mortgage advisors are concerned, it does affect you. If you're looking at an interest-only mortgage protected by a pension fund or pension tax-free lump sum, that's a good one to have as well. You might get involved in the long-term care market, or you might get involved in the equity release market, and therefore you'll understand about home income plans as well. But the key thing is, though, you need to be a practicing IFA, a level 4 qualified IFA, to give advice on annuities, if of course you ever want to. So that's an area you might want to consider at some point in the future. It's moving your technical capability towards that level. So there's an update for you on annuities. Hope that's been useful. Well done, everybody. I hope you enjoyed that update. It's interesting, isn't it, where you think about the changes in interest rates and how they affect things. Interest rates, as we said, are on their way up. They're not going to come down for a long while yet. Maybe when the recession kicks in and the Bank of England might want to sort of improve things, they might reduce interest rates. It may be a year, 2 years before they come down again. Will they get down to rock bottom levels? I don't know. We'll have to wait and see. But you need to get used to high interest rates. And that now comes on to our next topic, which I want to share with you, is the market for buy-to-lets. What's happening to the buy-to-let mortgage market? Because that might be an area that you're involved in. And high interest rates are beginning to affect the allure of the buy-to-let market. So I want to share that with you for the next sort of 5-10 minutes or so on that topic. So buy-to-let mortgage market. Let's go over to the whiteboard for this then, so we can give you an update on this one. And we'll just rub that out so we can get ourselves comfortable with that. Buy-to-let mortgages have been around for a long time, and they've driven the marketplace for the private rental sector, which of course competes with people buying their own property. And there's nothing wrong with that at all. People need good houses to live in. And landlords have spent money on houses, done them up, and there's a really good private rental sector in this country. But the people that buy these properties and rent them out, landlords, are investors. They're business people like everybody else. They're looking for an investment. So what they're now thinking about is, do they want a buy-to-let mortgage? In other words, a rental property, or do they put their money into shares? So there's the question now to think about, because it's not so popular now to have buy-to-let mortgages. They were very popular, of course, in the early noughties and the teens, as we call them, because interest rates have been really low, even buy-to-let mortgages. But the tax started to change in 2016. Tax changes came in which diminished the fiscal benefit of a buy-to-let mortgage, particularly for people who only had 1 or 2 properties. And part-time landlords kind of pulled out, really, didn't they? And left it now to professional landlords who have a number of properties in their portfolio. But they still need to look at the pros and cons. Do they put their money into buy-to-let housing, or do they put their money into shares? So let's take a look at the pros and cons then. So let's take a look at buy-to-let first of all. And we've got plus here and minus. What I want to do now is just quickly share with you the benefits and disadvantages of investing your money in a buy-to-let property. First of all, the advantages. Let's look at positively then. So if you put your money into a property and take out a buy-to-let mortgage on that property and rent it out, you're going to have a good return in the form of rent. You're going to have a good rental return. Now, the good thing about the rental return is you can index link it. My son, his property, he rents here in Cheltenham, and his landlord is entitled to increase his rent by the CPI plus 3%. What's that all about? That's about 13, 14%. He can whack it up if he wants to, and he may well do if he's got a mortgage to pay, because the interest on his mortgage has gone up. The mortgage rates, we look on here, on buy-to-let now, so the percentage rates are going up, increasing. You may be on a fixed rate, 2 or 3 year fixed rate, 5 year fixed rate, but they come to an end, don't they? And the rates are going up now. So he needs to look at, balancing the books, rental coverage, that sort of thing. So that's the first advantage there. The second advantage is there's lots of demand. Demand for private rental is always there. There's a massive percentage of people that rent privately. Here in Cheltenham, for example, somebody puts a house on the market for rent. There's loads of people interested because there's a big demand for it. So that's good news all around, isn't it? Legally, you've got this lovely thing called the short hold tenancy. Short hold tenancy is a lovely document, which means that you don't have to have people for, hundreds of years or lifetime tenancies anymore. You can have a 6-month minimum tenancy if you want to. So you can get rid of tenants if you don't like them. And there are ways of evicting tenants as well if you want to go that route. The yield is particularly good, and that comes down to the rent, of course. The yield is the return it gives you. So if you invest your money in a property and that gives you rent, that's the percentage yield. And the yields are very generous now on these things. So you need to take a look at that area as well. But the big one, and I'll put it down the bottom there, is potential capital growth. Yes, you can have yourself an income profit, so long as your mortgage isn't too big. Your rent might give you a good income. But the capital growth is what they rely on mostly. Mostly house prices have gone up in the last few years. Will they come down? They may well do. I think what will happen with house prices is they'll stay pretty stagnant. They might move down a little bit if the estate agent gets a bit too frothy with their valuations. But of course, inflation at 10% means that if house prices stay the same, inflation goes up, house prices effectively are coming down. Whether we'll see a drop in house prices will depend on the area in which you live in. But again, it could fall. So that's another advantage of a buy-to-let property. Now, what are the disadvantages? Well, we've mentioned about the percentage rates. They are going up, therefore your costs are going up. There's also a lot of other costs to incur when you buy a property. Stamp duty, legal fees, estate agency fees, if you're selling, of course. There's all sorts of costs involved in purchasing a property. And that you can't excuse that as well. The mortgage interest that you're paying, if you're paying a mortgage on your mortgage or on your property, so if you're taking out a buy-to-let mortgage, you can offset that against the rent to reduce your tax. That's always been allowed, but you can only now do that at 20% tax at the basic rate. So what I'm saying here is that if you earn rent, you've got to pay tax on that. Obviously, it's income, isn't it? But if you have a mortgage, the interest, you can offset that against the rent to reduce your tax bill. Now, you can only now get tax relief at the basic rate on that. So it's coming down. Unless, of course, you take out a special purpose vehicle. If you invest in the property as a limited company, there's different taxes there as well. The big one, though, capital gains tax. If you sell the property, capital gains tax is 8% more than normal rate. So selling a buy-to-let property is expensive to do because you've got this big capital gains tax to pay as well. So don't forget that. It's also expensive to maintain a property. You've got to have all sorts of things like energy performance certificates. You've got to maintain everything, keep a look after it. It costs money to maintain a property. Of course it does. You've got legal responsibilities like the right to rent. You've got to check people out to make sure they have the right to rent. Otherwise, you can go to prison, I believe. There's some sort of laws involved in that area. So there's quite a lot of legal requirements as well going on there. So The main disadvantages is the costs, and the tax relief is coming down. The capital gains tax is quite high. So again, you want to weigh it up. Now, when interest rates that you're paying on a mortgage are quite low and you've got rent which is quite high, it's an easy one to work out, isn't it? You're getting a monthly income and you're probably making a bit of profit each month. And then coupled with the capital gain, that where prices, of course, have gone right up in the last few years, you're on a bit of a winner. But things have changed. The interest rate on your mortgage is going up. That means you're either going to put your rent up or you're going to make a loss each month. You're going to make an income loss, and nobody wants to make a loss. Yes, there's a capital gain, but if prices come down, there isn't. So the allure of buy-to-lets will start to diminish, particularly for small people that will have one house, maybe two houses. The professional landlords do it very differently, and they'll be looking at properties where they can get a higher yield, maybe a lower priced property that can still rent out at quite a bit of money, and they might do them up to increase their profits that way. Now, on the other hand, we need to look at shares. So let's look at share investments and just to sort of compare the two, really. So we're looking at stocks and shares, unit trusts, OEICs, all sorts of different collectives of buying shares. So let's look at advantage, disadvantage of buying shares. First of all, if you buy a share, you will hopefully get a capital gain, because share prices do vary on the stock market, and it may well be that your price of your share will go up. It might go down, of course. The stock market is something we can't control, and it is geared towards the economy, recessions, all sorts of issues around that as well. But you also get dividends. That's the thing people forget about shares. If you got yourself invested in a particular company that's highly profitable, it will pay dividends. It pays you twice yearly income on top of your capital gain. So it's very much two bites of the cherry. Buy-to-lets give that to you as well. They give you rent and they give you capital growth. Shares do the same. So that's something to think about. The other thing is choice. You've got all sorts of choice about how you invest in shares. You can invest directly in shares. Of course you can. You can invest in a pooled investment like a unit trust. You can invest in ETFs, exchange traded funds, which allow you to spread your risk across the entire index. You can buy your own company shares, share save schemes, and get some tax reductions that way. So there's lots of ways of buying shares where you're not taking a huge risk, because you're buying a collective, a whole spread of companies in a whole index, for example. Disadvantages of buying shares. Well, first of all, if you need advice, it costs money, advice fees. If you're looking for an IFA, a wealth manager, to manage your portfolio, he or she will take a percentage of your fund under management, and these are quite frothy. They're coming down. If therefore you want an active investment, somebody to actively invest the money for you, just move it around, etc., then that's quite pricey. If you want to have passive investment, in other words, let a computer base your investment on an index or stock market movement or something, then the advice fees are much lower. But there are advice fees involved. Not as expensive as buying a property, might I add, particularly if you're going for a passive investment. And let a computer, artificial intelligence, do the investing for you. It's much, much lower. The other one, of course, is the volatility. They're much more volatile. The volatility in the form of values. You often hear about the stock market crashing by 5%. The stock market crashed by 5% by close of play today. The following day, stock market is up again after a terrible first start of the morning. They're up and down like a yo-yo, aren't they? So quite scary, really. Unless, of course, you've spread your investment across a whole wide field of shares, and therefore the volatility is not so much. But, stock markets go down, stock markets go up. Property prices have tended just to go up over the last few years because of supply and demand, whereas, of course, stock markets are very different. You have what's called a bear and bull, don't you? You've probably come across that one. A bull market is where people are buying shares all the time. A bear market is where people are selling shares all the time. So a bull market is good, bear market is not so good. So they call it bear and bull. I don't know why they call it bear and bull, that's what they do. So therefore, you need to look at maybe shares. Are shares becoming more popular? Maybe with high interest rates, with your mortgage costing you a lot of money now, the tax benefits going down, your rents going up, but not too much because people can't afford high rent, capital growth not there anymore. Maybe buy-to-let investing is not so popular. Maybe these people want to be looking at shares as investment. I will say, though, that this is probably for people who are part-time investors. They have money to invest, and maybe in the past they've looked at buy-to-lets, and now they're going to be looking at share investments. Professional landlords, where she has a number of properties in a portfolio, will remain on buy-to-let. Let's get this right, on the buy-to-let area, because that's the marketplace. It's their business that they're running. But things change all the time. So I hope that's been an update for you on buy-to-let versus shares. That's been useful for you. There you go. Hey, quite a long live stream today. Actually, we've been talking for half an hour on the topic, haven't we? So hopefully there's been a couple of updates for you on the topic. Been a case of interest rates, really, and how they affect the market. The key message here is that interest rates are going up. We're going to be living, I think, in a society or an economy with higher interest rates than we've ever had for quite a long time. They might come down a bit, maybe late next year, 2024, who knows, when the recession starts to drive in. The Bank of England might reduce rates to stimulate the economy. At the moment, they're trying to increase rates to combat inflation, because that's what they're trying to do. And that actually will cause a downturn. It's starting to happen in the US already. And maybe they want to come out of the recession that they've created themselves, and therefore they might reduce interest rates later. But I don't think we're going to get down to those rock bottom interest rates we've seen over the years. So getting used to higher rates really is the key. So let your customers know that. That's what's going to happen. Anyway, enough of that. Good information, good updates for you. Hope you enjoyed the live stream. I'll be seeing you all again hopefully next Monday. So have a great week, everybody, and see you soon. Bye for now.